The Fringe benefits tax year ends on 31st March, and that cutoff is closing fast for every small business that hands staff a car, entertainment, or salary package perks. This is self-assessed, which means the ATO expects you to find, value, and report every benefit yourself. And they have flagged the avoidable mistakes that catch employers out. Here is what is happening in plain English. According to the ATO, the FBT year runs from 1 April to 31st March, and employers must self-assess the tax on benefits provided across that whole period. That means right now you need to go back through everything you gave staff and work out the taxable value of each benefit before lodgement. Why does this matter so much? Because the ATO applies FBT at 47% of the grossed up value of a benefit, not the simple cost of the perk. That gross up is the trap. A car or entertainment benefit that felt small in dollar terms can produce a surprisingly large tax bill once the rules are applied properly. These are the figures driving the whole exercise. The ATO applies a 47% rate to the grossed up value. And once an employee's taxable fringe benefits pass $2,000 in a year, the grossed up amount becomes reportable on their income statement. Some minor benefits under $300 may be exempt, which is exactly why classifying each item correctly matters so much. Here is the sharpest stat in the whole bulletin. If an employee's taxable fringe benefits exceed $2,000 for the year, the grossed up amount must be reported, according to the ATO and NFP law. The kicker is that this applies even when the benefit itself is FBT exempt, such as an eligible electric car. Here is the detail buried in the rules that trips people up. Many employers believe that if a benefit isn't paid as cash, it doesn't need to be declared. But the ATO says FBT applies to many non-cash benefits and requires records and employee declarations to be kept. Even FBT exempt items like an eligible electric car can still appear as a reportable amount once an employee passes the $2,000 mark. So what should you actually do right now? First, review every benefit provided across the FBT year using the ATO's guidance. Check payroll, reimbursements, car logbooks, entertainment, and salary sacrifice records. Second, calculate the taxable value and flag which employees cross the $2,000 reporting threshold. Third, lodge your FBT return on time and keep the supporting declarations because the ATO can ask for them. Mark these dates now because they are firm. Self-preparers generally need to lodge and pay by 21 May, while eligible electronic lodgements through a registered tax agent usually extend to 25 June, according to ACP accountants and reporting from Yahoo Finance Australia. Missing the window turns a manageable task into an avoidable compliance problem. Looking ahead, this is an area that keeps moving. The electric car exemption rules are time-sensitive and changed from 1 April 2025 for plug-in hybrid vehicles, according to reporting on the ATO changes, so a benefit that was exempt last year may not be treated the same way now. Recheck current year treatment, rather than relying on what worked previously. Tax deadlines and exemption rules change every single year, and missing the detail is what costs small businesses money. Follow the fine print and we'll keep you across the next FBT change, the next ATO warning and the next deadline before it sneaks up on you.